Hello, welcome back. So a lot of your high quality compounding machine stocks are actually crashing. And for reference, this is my portfolio. So I own a lot of different compounding machine stocks here. And the ones that I'll be talking about today include MSCI, ASML, as well as Equifax. So MSCI today is down around 9% and is currently trading at around 35 times earnings, giving out a 1.37% dividend yield. So the stock actually reported their earnings. Their earnings were quite amazing. So revenues went up by 9%, operating income went up by 11%, diluted EPS went up by 16%, and overall it was business as usual from MSCI, but they missed slightly on their revenue report. So for MSCI, it has seen amazing growth over the past few years, and the thesis for MSCI is extremely simple. It's just the index business continuing on in its path of growth. So for MSCI, for example, this is their assets under management. And as you can see, the assets under management has grown at around 19% since 2008 all the way until 2025. So this is amazing growth from MSCI. It is simply just a toll gate business. So MSCI is similar to S&P Global, is similar to Moody's as well. So for MSCI, it is similar to your S&P 500. What they do is they collect a fee, a percentage of the assets under management that use the MSCI branding. So this is a toll gate business. They don't do anything. So all they do is they'll come out with the indices, and then all these different asset managers, they'll create the ETFs and then they'll link it to MSCI, and then MSCI will collect a fee from there. So it is a highly recurring business, and you will likely see this company continue on with its compounding over the next few years, over the next 10, 20 years, because you will continually see people putting money into the markets, and as people move from active investing to passive investing, you'll see even more money and cash flows coming into all these different ETFs. So for MSCI, this is the reason behind the stock falling. So the retention rate came in a bit lower than expected, and the revenue also came in a bit lower than expected. I view this as an overreaction, and the CEO also said that he's focusing more on retention rate rather than growth. This led to some sort of overreaction by the market. That is why the stock is down around 9% today. So there was a similar case last year as well in 2024, where MSCI dropped their retention rate to around 92%, and then the stock fell by around 20% in the span of 2 days. That provided an amazing buying opportunity for MSCI, and I view this as one that is similar as well. MSCI is probably one of the highest quality businesses out there, and this is my valuation for MSCI. So for MSCI, assuming a 12% free cash flow growth from this year until year 10, and assuming a 4% terminal growth rate, the terminal growth rate is a bit higher because for MSCI, I expect it to continually grow and compound beyond the 10 years. So at its current free cash flow of $1.4 billion, the company has a fair value of around $595 a share. Because the company bought back some shares, that's why the fair value is slightly higher than what it was last quarter. So for MSCI at its current price, you're buying it at around 10% margin of safety. And that's why I think it's a decent buy today with this overreaction after its earnings. So for MSCI, the price to free cash flow is also at a historical low over the past 5 years. You never saw this level in the past 5 years. In fact, over the past 5 years, the mean price to free cash flow is around 40 times. So at its current price to free cash flow today, it is significantly lesser as compared to its historical levels, and that's why it looks attractive today. So for MSCI, it is a high quality business, probably one of the highest quality businesses out there. The company is trading at a low valuation relative to the past few years, and it is selling down over a small retention miss. So I view this as an overreaction, and that's why I added to my position, and this company will likely stay around for a very long time. The next company that I'll be talking about today is Equifax. So Equifax, similar to MSCI, is down after its earnings. It's down around 7% today. It's currently trading at around a 48 times earnings, giving you a dividend yield of around 1%. So for Equifax, their Q2 earnings were quite strong as well, although it missed estimates. So revenues went up by 7%. The workforce solution also went up by around 8% in terms of revenues. Active records went up by 10%. USIS revenue went up by 9%, and international revenue went up by 6%. So they're maintaining their 2025 guidance, and for Equifax, this is basically business as usual. So besides that, Equifax also bought back a lot of their shares, so they're starting to return capital to their shareholders after they've finished migrating their cloud. So in the past, MSCI actually spent a lot of their money, a lot of their free cash flow on CapEx because they had to build up the cloud. But currently now, since that cloud is down already, MSCI can start returning cash to its shareholders. And that's why you saw around $127 million worth of buybacks in Q1 of this year. So Equifax is aiming for around $3 billion worth of buybacks over 4 years. So that is around 10% of the entire float, which means you're getting around 2.5% share reduction every single year. And besides that, Equifax is also aiming for $1 billion of cash returns to its shareholders every single year. So this could be a start of an inflection point for Equifax. They've migrated a lot of their services to the cloud, which leads to higher efficiency and higher margins. And besides that, their workforce solution is also growing rapidly as well. So you're currently seeing a lot of Medicaid cuts and higher Medicaid requirements, which leads to a higher usage of your workforce solutions. And your workforce solution has a massive runway for growth because a lot of your verification services nowadays are still manual and still on paper. And once they transition it to online, once they transition it to your workforce solutions, that could be massive growth for this portion of the business. So for Equifax, they're aiming for between 8 and 12% total growth in this long-term target. They're aiming for 12 to 16% EPS growth every single year, with annual shareholder returns of between 13 and 18%. So with this long-term target that the company has, let's estimate that the free cash flow grows at 13% for the first 5 years, followed by around 11% over the next 5 years. So at its current free cash flow of around $900 million, the company's fair value is at around $215 a share. So for Equifax, I view it as a company that is still slightly overvalued, although it might be worth it paying up for Equifax over the long term. So for Equifax, it is a company that is undergoing some form of transition. This could be an inflection point for the company, but at its current price today, I still view it as slightly expensive. And between MSCI as well as Equifax, I think MSCI is the better buy at today's price. The next company that I'll be talking about as well is ASML, of course. So ASML year to date is currently flat and is currently trading at a 24 times earnings. So for ASML, the current valuation is at one of the historical low points. So the last time it traded at such a low valuation at around a 20 times earnings was in 2018 during the Trump tariff period, and is currently trading at around that valuation as well. And for this company, it has a complete monopoly in your patterning and your lithography space. So for this entire chain over here, the most important portion is actually your patterning segment, and ASML holds a monopoly in that segment. So for the company today, it is attractive. It is a monopolistic company that is trading at a low valuation, a mere 24 times earnings for this company. So I view it as significantly undervalued. So for ASML, the current 2030 guidance is still intact as well. So they're projecting between 44 and 60 billion of net sales in 2030. So this is actually based on your global demand for wafers in 2030. So it doesn't matter if Samsung or Intel cut their capex this year, because this is a calculation based on the demand. And if the demand is there, some company will still have to buy from ASML anyway. So for ASML today, I view it as a high quality business with a growing installed base. It is becoming more and more predictable with that portion growing, and the streets are selling it off because there may be no growth in 2026. The long-term target still stays intact, and this is actually an opportunity for you to buy into an absolute monopoly at this price. I view it as extremely attractive today, especially at its 24 times earnings. So the company now is trading at a discount relative to its peers in the same sector, although it is the highest quality one in the entire sector. So I view this as a highly monopolistic company, and I'll be looking to add into ASML soon. Last portion, I'll be covering some questions left in the comments. So the first one, it says, do you have opinions on Evolution Gaming, Samsung, or Zoetis? So Evolution Gaming is a company that does your gambling websites. But for Evolution Gaming, my problem with the business is it is too reliant on Asian growth. So for the company, it has majority of its growth coming in from the Asia segment, and that is also the highly unregulated segment. So if we see some form of regulation in those segments, then I think this could hurt the growth for Evolution. Although it is a company that is trading at a relatively cheap price, I wouldn't be interested in adding into this one, simply because of the risk associated with that portion. The next company is Samsung. Samsung is just inferior to TSMC, so I think TSMC is the better buy here. As for Zoetis, it is a company that sells your animal drugs, and it has a lot of your patents associated with some popular drugs. But for Zoetis, I think it is a company that is simply too complex. Although it is less regulated as compared to companies like Merck that sells human drugs, it's an avoid for me simply because the company is a bit too complex for me to understand. Next comment, it says, can you give any advice on Texas Pacific Land? So I believe this company, what it does is it has a royalty business. Basically, it owns a lot of your important lands, and what they do is they will lease out the lands, and then they also collect a royalty on all the commodities that are dug out of this land, or on the profits produced on all these different lands. So for this company, it is a high quality business, of course. It is an asset-light recurring revenue business because they already own the land. But the problem with the company is simply just the valuation. I think it is trading at a relatively high valuation. It is currently trading at around 50 times earnings. Although it is high quality, I think paying up for 50 times earnings company could be a costly one in the future. So for TPL, I would avoid this one currently. I think there's another company that looks interesting as well. It is LandBridge. They operate in some sort of a similar fashion, except for the fact that LandBridge has a lower valuation as compared to TPL. I hope you guys have found this one useful and invest safe.